What's going on, Garrett?
What's going on, Michael? How you doing?
All right, I'm doing great. I want to talk about a little bit about underwriting in these kinds of times because we're seeing people sharpen their pencil maybe a little bit too much, where they kind of break off because they're trying to be a little aggressive to try to get deals done, and they compromise and they do a little bit of here, a little bit of there. What are some of the aggressive underwriting assumptions that people should be cautious about?
So you're going to see this more and more as the market tightens up. Specifically, what I think you're going to find is, people out there are not. There's a couple metrics that you really want to pay attention to when you're vetting an operator. First off, is their assumptions on their natural rent growth. So there's typically the rent growth that you're going to see in any real estate market on a pro forma is somewhere between 1.5 to 3.5%. And it's really easy to get better numbers if that is on the high end, if they're at 4% or 5%, because the market at the time, maybe it's in Phoenix or it's in Florida where they're actually getting that. And what I'm talking about is like when people renew their lease, they're getting a higher renewal rate, like 5% or 6%. If they're putting in that in their assumptions, way too aggressive. One thing we always do, well, we're not doing year one, we're taking that out completely, but I love modeling in as far as padding a really high economic vacancy years 1 and 2 while you're doing your renovations. So that's the other thing that can be easily missed is you're looking at someone's underwriting and they're like, oh, they only modeled 10% economic vacancy. So 90% average occupancy economic. That's probably not realistic, especially if they got a construction project going on. There's units being turned. There's chaos. They don't really know how to run that asset right away. So you definitely want to look out for that out the gate. Other big one is the reversion cap rate. And that one can make the biggest impact on the IRRs that go into a deal. So you want to look out for how low are they going? What's actually the market reversion cap rate? And that's the exit cap rate when you go to sell the property. Moving it just a tenth of a point can adjust their returns up or down significantly. So the way you find that if you're an operator like us is you look at what the market's been trading at, and then we try to go a minimum of 50 basis points over where the market's been trading. So if you're in a nicer area with a nicer vintage property, that cap rate's naturally going to be lower. As it gets a little bit more C class, that's going to be towards the higher end. And then definitely it's based on the location as well. And so you as a passive investor or even active, should be definitely watching that to make sure that's not too far off the rails, because that makes a really big impact on everything.
Yeah, that's really good because a lot of investors they compare one deal to another and just look at the return, and that is not the way you look at deals. To return is a factor. The other one, of course, is the team behind it, and then when you get closer to a deal, the assumptions behind it. I mean, we've seen deals recently from other operators and great returns, but the assumptions are like, ooh, that's a bit aggressive, isn't it? And for the reasons you just talked about, and unfortunately. The investors aren't looking for that. They just see the pretty pictures and the nice numbers, and they're not looking at the assumptions behind it. But you have to be conservative right now in these times. Always have to be conservative, and some of those things are pretty aggressive. Hey, just want to remand you, we're going to have Dealmaker Live this year in Dallas, Texas, July 16 to 17. Head over to dealmakerliveevent.com to grab your tickets. It's going to be in person or virtual, whichever you prefer. I'll see you there.